Picture this. It's 6:12 in the morning. Your phone lights up before you're even fully awake. One notification says your rent autopay failed. Another says your credit card payment posted late. Then your bank hits you with an overdraft fee, not because you were reckless, but because 3 payments landed in the wrong order while your paycheck was still pending. By 7 a.m., you've lost money, your credit may take a hit, and the entire rest of your month is now a recovery mission. That's how financial stress actually works. It usually doesn't arrive like a Hollywood disaster. It arrives like a timing problem, a payroll delay, a forgotten renewal, a car repair 2 days before rent, a subscription you swore you cancelled, a balance that looked safe on Tuesday and dangerous by Thursday. And once that chain reaction starts, you're no longer making smart decisions. You're making emergency decisions. That's exactly why I automated my entire financial life. Not because I'm obsessed with productivity, not because I wanted some shiny money hack, and definitely not because I think discipline alone is enough. I did it because I realized something most people don't want to admit. If your financial life depends on you remembering, deciding, resisting, tracking, and behaving perfectly every single week, then you do not have a financial plan. You have a fragile emotional system pretending to be one. But here's the real problem. Most people think they're one good month away from being organized. They think if they just try harder, check their balances more often, or finally commit to a budget, everything will stabilize. But money usually doesn't fall apart because people are lazy. It falls apart because the system is badly sequenced. Bills hit before buffers. Spending happens before saving. Decisions happen after temptation. And important moves, like investing, paying down debt, or building reserves, are left to whatever is left over. There is almost never anything left over. Whatever is easiest gets paid first. Whatever is automatic gets repeated. Whatever requires effort gets postponed. That is not a character flaw. That is human behavior. And once you understand that, your financial life changes. Because the goal stops being, I need more self-control, and becomes, I need better defaults. Now this matters because the economy punishes bad defaults hard. The Federal Reserve's latest household well-being data says only 63% of adults say they could cover a $400 emergency using cash or its equivalent, and 13% say they couldn't cover it by any means. Only 55% say they've set aside 3 months of emergency savings. That means millions of people are not one catastrophe away from trouble. They're one annoying, ordinary expense away from trouble. Federal Reserve. At the same time, household debt in the U.S. reached $18.04 trillion in late 2024. Credit card balances alone hit $1.21 trillion, and the share of debt already in delinquency ticked up again. So even before a recession headline, a layoff, or a market panic, the system is already under pressure. People are carrying more, paying more, and recovering more slowly from simple mistakes. New York Fed. And this is where most people get it wrong. They hear automate your finances, and they think that means turning on autopay for a few bills and calling it a day. That is not automation. That is surrender. If all you automate is the money leaving your account, then you've built a system that works beautifully for your landlord, your lender, your utility company, your streaming apps, and your insurance provider. Everybody gets paid automatically except your future self. A real automated financial system has one job. It must protect you from your own forgetfulness, your own stress, and the random ugliness of timing. It should make the right move happen before you are tired, distracted, emotional, overconfident, or scared. It should lower the number of decisions you make when stakes are high. And it should keep working when life gets noisy. So here is the exact system. Not a fantasy system. Not one built for finance influencers with 6 income streams and color-coded spreadsheets. A real system for normal people who want fewer money fires, fewer dumb fees, less decision fatigue, and a much stronger floor under their life. The first layer is the landing zone. Most people get paid into one checking account, and from that single account they try to do everything. Pay bills, buy groceries, invest, cover emergencies, handle subscriptions, and somehow stay calm. That's the financial equivalent of running an airport with one runway. One delay and everything backs up. My system starts by separating incoming money from active spending immediately. Every paycheck lands in a primary income account. That account is not for daily life. It is the staging area. Nothing gets swiped from it. No coffee, no takeout, no random online orders at 11:40 p.m. It exists for one reason only: to receive income and route money with precision. From there, I automate transfers into 3 directions. First, the operating account. That's where weekly spending lives. Groceries, gas, small purchases, anything variable. Second, the bills account. That's where fixed obligations live. Rent, utilities, insurance, phone, internet, subscriptions, minimum debt payments. Third, the future account cluster. Emergency savings, sinking funds, investing, and long-term goals. This is not complexity for the sake of complexity. This is containment. When all your money sits in one pile, you lie to yourself. You look at the balance and think, "I'm good." But that number is fake, because part of it already belongs to rent, part to insurance, part to taxes if you freelance, part to next month's car repair, and part to a version of you that desperately needs a cash buffer. One big number creates false confidence. Separate lanes create clarity. And the timing matters. The routing happens automatically within 24 hours of income hitting. Not at the end of the month. Not when I get around to it. Not after a weekend of impulse spending. Money gets assigned before it gets emotionally interpreted. That one change alone removes a shocking amount of anxiety, because you stop waking up wondering what the number in your checking account actually means. The second layer is the bill firewall. This is where most financial systems quietly fail. People automate bills from their everyday checking account, but they keep spending from that same account. So the bill isn't really automated. It's competing. Every grocery run, every dinner, every small, "I deserve this," every gas station stop is now in a silent knife fight with rent, insurance, and utilities. That is how perfectly responsible people get blindsided. My rule is simple. Fixed bills come out of a dedicated bills account or a dedicated bills card that is paid in full automatically from the bills account. That account gets funded on payday based on the monthly total of all required bills plus a built-in cushion. Not a theoretical cushion, a real one. At minimum, 1 month of fixed expenses sitting there as a shock absorber. So if payroll is delayed, if a billing date shifts, if a charge posts early, if a renewal I forgot about sneaks in, the system takes the hit, not my peace of mind. I also align due dates wherever possible. Same week, same cluster, fewer surprise hits. A lot of companies will move your due date if you ask. That matters more than people think. Chaos isn't just about how much you owe. It's about when everything hits. Timing is a hidden tax on the disorganized. And yes, autopay is on. But autopay only works well after the account design is right. Autopay without account architecture is like putting cruise control on a car with bad brakes. The third layer is the anti-fragile emergency system. Most people say they want an emergency fund. What they really have is emergency intention. The fund itself never appears because they wait for a magical month when money feels abundant. That month rarely comes. So I automated the emergency fund like a bill. Not a leftover, not a bonus move, not a heroic act. A bill. A fixed transfer goes out after every paycheck into a separate high-yield savings account at a different bank. Different bank matters. If the money sits one tap away from your debit card, your brain will treat it like optional spending. Separation creates friction. Friction protects future you. The first target is not 6 months. That number is so big that people freeze. The first target is a micro buffer, large enough to stop overdrafts and minor disasters from becoming debt. Then 1 full month of basic expenses. Then 3 months. After that, depending on your job risk, health situation, family structure, and volatility of income, you can decide whether you need more. But here's the real psychological trick. The emergency fund must grow before you feel secure, not after. If you wait until you feel okay to automate it, you will never begin. Security is not the reward for building the system. Security is the byproduct of the system. And this is where the data becomes brutal. Consumers still paid more than $5.8 billion in overdraft and NSF fees in 2023. And the CFPB says reforms on overdraft could save consumers up to $5 billion annually, or around $225 per household that pays those fees. Think about that. Entire business models have been built around people being slightly out of sequence. That is how expensive disorder is. CFPB, the fourth layer, is the debt kill switch. Debt gets emotionally heavy because it demands repeated moral effort. Every month, you have to decide again whether you're serious. Every month, you have to be good. Every month, life offers you a reason to postpone. That is exactly why debt stays alive so long. My system removes the monthly debate. Every debt account has automatic minimum payments on, no exceptions. That protects the downside. Then one separate automatic overpayment hits the target debt right after income arrives. Not at the end of the month, right after income arrives, while optimism is still high and excuses are still weak. You can use Avalanche if you want the highest interest debt gone first. You can use Snowball if you need motivational wins. People fight about that too much. The bigger truth is this. The method matters less than whether the extra payment is automatic. Because debt thrives on hesitation. If you leave extra payments to manual choice, then debt is now competing against brunch, boredom, stress shopping, holidays, social pressure, and your own desire to just breathe for 1 month. And debt wins that contest way more often than people admit. I also do one thing that sounds small but changes behavior fast. I never let lifestyle upgrades absorb the full raise. If income goes up, part of that increase gets automatically captured by the system before my habits learn the new number. Some goes to debt, some to investing, some to buffers. If you don't pre-capture income increases, they vanish into a nicer version of the same instability. The fifth layer is the investment conveyor belt. This is where automation stops being defensive and starts becoming wealth building. Most people invest inconsistently because investing feels optional in the short term and urgent only in the abstract. Rent is real. Groceries are real. Market volatility is loud. Retirement is distant. So unless investing happens by default, it gets delayed by very reasonable-sounding excuses for years. Here's what history shows. Behavioral finance has shown again and again that default settings are powerful. Research summarized by Harvard Business School found that under automatic enrollment, retirement participation can jump to roughly 95% shortly after it takes effect, creating a gap of about 35 percentage points versus standard opt-in enrollment at early tenure. In plain English, when saving becomes the default, people save. When action is required, people stall. That principle runs my investing system. Retirement contributions are automatic. Tax-advantaged accounts first where available. Broad, boring, low-cost index exposure by default. Then a brokerage transfer for longer-term wealth building once the emergency system and high-interest debt plan are in place. The amount matters, but the sequence matters more. I don't wait to see how the month goes. I decide once, then let payroll and scheduled transfers do the heavy lifting. But I also learned an important lesson from the research. Defaults can help you, and defaults can trap you. In many auto-enrollment plans, people save more than before simply because they're enrolled. But they also stick to low default contribution rates for too long. So the fix is simple. Automate escalation 2. Every time income rises, contribution rates rise a little. 1% here, another percent there. Small enough not to hurt, consistent enough to change the future. That is how you use inertia in your favor. And if someone says, "I'd rather decide manually," I get it. It feels more responsible. But manual often just means delayed. And delayed over a decade is expensive in a way that never feels urgent until it's brutal. The sixth layer is the protection stack. Because a financial life is not just about growth, it's about survivability. I automated my savings and investing, yes, but I also automated the boring protections people ignore until life forces the lesson. Insurance premiums are automated from the bills system. Annual policy review reminders are scheduled. Beneficiaries are reviewed on a repeating calendar. Credit reports and account alerts are turned on. Large purchase alerts hit my phone instantly. Passwords live in a proper manager. Important documents are stored where they can be found under stress, not just under calm. Why? Because financial collapse often comes from the side door, not the front. A medical event, fraud, identity theft, a missed premium, a dead laptop with no backup, a partner who doesn't know where the accounts are, a family member trying to untangle everything while grieving. Those are not edge cases. Those are normal life risks. And this is where most people get it wrong. They think automation is just cash flow. It's not. Real automation is continuity. It means that if you are sick, exhausted, traveling, grieving, laid off, distracted by a newborn, overwhelmed by caregiving, or simply not at your best, the critical financial functions still happen. That's when a system proves whether it was smart or just aesthetically organized. The seventh layer is what I call the human override. This might be the strongest part of the whole system because it corrects the biggest myth about automation. Automation is not set it and forget it. Automation is Decide once, review briefly, improve occasionally. So, once a week, I do a short money check-in. 15 minutes, sometimes less. No dramatic budgeting ritual, no spreadsheet cosplay. I just answer a few questions. Did income route correctly? Did any unusual charges hit? Did the bills account stay above cushion? Did debt payments go out? Did savings and investments transfer? Did anything in life change enough that the system needs updating? That review is crucial because a system can drift silently. A canceled subscription comes back, a premium rises, a due date changes, a side hustle creates tax exposure, a bank changes terms. A raise should trigger a higher contribution rate. Automation without review becomes negligence. Review without automation becomes exhaustion. The combination is what works. Now let me tell you what changed once the full system was in place. The first change was not that I became richer overnight. The first change was that I became harder to damage. A forgotten bill stopped being a crisis. A weird week stopped becoming a bad month. A surprise expense stopped instantly reaching for the credit card. My spending got calmer because the important money had already left. My investing got steadier because it no longer depended on confidence. My debt fell faster because my future self didn't get a veto every month. And maybe most importantly, I stopped using mental energy to keep my finances from leaking. That mental energy came back into my life like oxygen. And there's a deeper lesson inside that. A lot of people are trying to optimize returns when what they really need is to reduce fragility. They want the perfect stock allocation, while their bill timing is chaos. They want the perfect side hustle, while they're paying overdraft fees. They want a more sophisticated portfolio before they have a 1-month buffer. But wealth is not just what grows fastest. Wealth is what breaks slowest. The 2008 financial crisis taught that lesson in one way. Millions of people thought they had security because they had rising home values and access to credit. Then the environment changed, liquidity disappeared, and what looked solid suddenly wasn't. More recently, the 2023 Silicon Valley Bank collapse reminded everyone that confidence can vanish fast when access to money feels uncertain. The FDIC noted that over 90% of SVB's deposits were uninsured, and once depositors believed access might be at risk, the rational response was to run. Different scale, same truth. People don't panic only when money is gone. They panic when certainty is gone. FDIC. That's why the strongest insight in this entire system is not automate everything. It's this. Automate your priorities in the order that protects your nervous system. That means income routing before budgeting, bills before lifestyle, buffers before bravado, debt reduction before convenience spending, investing before opinion, protection before confidence, review before drift. If you reverse that order, your financial life stays emotionally loud. You may earn more and still feel behind. You may budget harder and still get blindsided. You may invest more and still feel unsafe. Because the system underneath is unstable. But when the order is right, something strange happens. Money gets quieter. You stop checking your account with dread. You stop negotiating with yourself every payday. You stop relying on memory for things memory is bad at. You stop treating financial peace like a mood. And you start living like your money has a job before you ever touch it. That's real automation. Not a dashboard, not a trend, not some aesthetic finance setup with 6 apps and a neon pie chart. A machine that moves your money towards safety before life can drag it toward chaos. So if you want the practical version, here's the action rule. Within 24 hours of every paycheck, every dollar should receive a default destination. Bills should go to a bill system. Emergency money should go out automatically. Debt should get attacked automatically. Investments should happen automatically. Variable spending should be capped by what remains, not by what you hope to resist. If your current setup doesn't do that, then your financial life is still too manual. And manual systems fail exactly when life gets hardest. Start smaller than your ego wants, but start tighter than your habits prefer. Open the separate bills account. Build the 1-month cushion. Turn minimum payments on. Create the emergency transfer. Schedule the investment. Set the weekly review. You do not need a perfect setup this week. You need a safer one. Because the goal is not to become the kind of person who is endlessly motivated. The goal is to become the kind of person who no longer needs motivation for the most important financial moves. That is freedom. That is resilience. That is what security actually feels like. And if you're being honest, most people don't need more financial advice right now. They need fewer chances to fail. If you want, drop a comment with the one part of your money life that still feels manual. Bills, debt, investing, emergency savings, whatever it is.
I read those, and it'll also tell me what system breakdown I should cover next.
And if this helped you think about money less like willpower and more like architecture, subscribe. Because in a world getting more expensive, more automated, and less forgiving, the people who build better systems will sleep better than the people who just keep promising themselves they'll try harder next month.